There's only one way to do the calculation, and it's pretty straightforward. You've seen that. But there is a lot of wiggle room in terms of what you include in each of the calculation sources. For example, what some people include as liabilities will differ. Some owners will use accounts payable and accrued liabilities out of the liability number, and others might look at short-term versus long-term debt in comparison to equity. So find out exactly what your company counts in its calculation. It's common for smaller businesses to shy away from debt, so they tend to have very low debt-to-equity ratios. Usually, one of the first things the owner wants to do is to get out of debt. But that's not always the best move for the business. Owners should be using debt because it's a more efficient way to grow the business than just being debt-free. So, it's a matter of balance. Healthy companies use an appropriate mix of debt and equity to keep their businesses going strong. Just like some days I eat salads and go to Pilates, and other days I eat cupcakes and don't put on pants. Balance is what keeps me strong. The last two ratios are related. These are the accounts payable and accounts receivable turnover ratios. Let's talk about accounts payable turnover first. This ratio shows how many times a company pays off its accounts payable during a period, which shows how efficient a company is at paying its suppliers and short-term debts. The formula for this little gem is to divide the total purchases during a period by the average accounts payable. Let me illustrate with an example of something related to something near and dear to me. Bob's Bakery Supply purchased $600,000 worth of baking equipment from his vendors during the year. According to Bob's balance sheet, his beginning accounts payable was $35,000 and his ending accounts payable was $458,000. Bob's average accounts payable for the year was $246,500. You get this by adding the beginning plus the ending and dividing by 2. Based on this formula, Bob's turnover ratio is 4.1. If we divide this number by 365 days in the year, we get 89.02. This means that Bob pays his vendors back on average once every 3 months. This isn't a high turnover ratio. Maybe you think Bob should pay vendors back more quickly. But the ratio should always be compared to similar companies in Bob's industry. Generally speaking, a high AP ratio indicates that you satisfy your accounts payable obligations quickly.